Assalamualaikum and good day everyone. Today we will present The Rise and Fall of Management Accounting, which is authored by H. Thomas Johnson and Robert S. Kaplan. The research article is published in 1987 during a period of significant industrial transformation and global competition. The authors critically evaluate an historical development of management accounting practices. They argue that management accounting, once central to the managerial decision making, had become increasingly obsolete due to excessive focus on financial reporting for external stakeholders. Our presentation will cover the following: the challenge, the opportunity, management accounting tool, loss relevance, academic literacy, accounting for caravan, the call for innovation, and finally, our conclusion. So, let's begin with the next group member.
The central challenge was the growing gap between managers' needs and what accounting systems actually provided. By the mid 20th century, businesses were no longer simple manufacturing firms. They faced intense global competitions, technological change, and more complex production systems. Managers need timely and detailed information for cost control, quality improvement, and strategic planning. However, accounting systems were stuck in the past. They focused too much on external financial reporting, which is preparing profit and loss statements, balance sheets, and compliance documents. These reports were not designed to help managers with daily operations or long term strategy. So, the challenge was clear. Accounting had not evolved with business realities.
Despite the challenge, there was also a great opportunity. Management accounting could evolve with the reduction of information collection and processing costs. As digital computers are more used, information recording can be done in real time and continuously. This combined with technologies such as automation and LAN, local area network, helps company to improve efficiency, design better products and stay competitive in the market. Which means to say, the accountants need to move beyond the old simplified and aggregated procedures in favor of new, more accurate, timely and effective reporting and control systems.
My focus will be on the roots of management accounting in this learning. We first need to look on its roots from the late 19th and early 20th centuries during the rise of the big industry. From around 19,000 to 1925, this period is often called the golden era of management accounting. At that time, it was highly innovative and played a central role in business progress. The early purpose of management accounting was not about producing reports for shareholders or regulators, but about helping managers make better decisions. It provides relevant and timely information of planning, controlling operation, and improving efficiency. Some of the key routes include digital support, giving managers the information they need to guide strategy and daily operations. Second, cost control and efficiency, where techniques were developed to reduce waste and improve efficiency, to improve productivity. Third, the creation of innovative tools such as standard costing, variance analysis, and budgeting, which became the foundation of modern management practice. Next, there was strong integration with operation. Accounting was closely tied to factory process, monitoring labor, and materials and machines. Finally, management accounting developed performance measures like return on investment that help managers evaluate the divisions and allocate capital effectiveness. This practice were very influential. For example, companies like DuPont and General Motors pioneered advanced accounting system to manage their large, complex operation. In this golden era, accounting was not just about recording numbers, it was an active driver of efficiency, innovation, and competitive advantage. Unfortunately, after 1925, innovation in management accounting slowed dramatically. The focus shift away from supporting managers toward producing standardized financial report for external users. Academia reinforced their trend by emphasizing financial accounting theory on compliance with GAAP while neglecting managerial needs. Over time, management accounting lost its relevance to business decision making. Instead of being forward-looking, it became what Johnson and Kaplan described as accounting for the caravan, tracking where the company had already been rather than guiding where it should go.
By the 1950s and onwards, the management accounting had largely lost its relevance, and these are some of the factors. The first one, instead of their focusing in internal decision making, they shifted their focus to the external reporting. The second one, they ignore the changes in industrial. They stay in the same accounting methods despite having the new technologies. The third one, manager lack useful data for planning, control, and pricing decisions. And the last one, the lack of innovation because there has no major improvement to support their strategic management.
Next, accounting caravans. The article uses the metaphor of accounting for caravans to describe this problem. Imagine a caravan that has already moved far ahead, but the accounting reports are still describing its locations from days before. This is exactly what happened. While the management accounting provided delayed historical information that was no longer useful for decision making. Managers could only react to the past instead of planning for the future. In fast changing industries, this delay was damaging. By the time reports reached managers, the business environment had already shifted.
Alright, next part is academic literacy. So, Johnson and Kaplan also highlighted the role of academic in the decline of the management accounting. They argue that research in accounting, particularly during the mid-20th centuries, became heavily concentrated on financial reporting, auditing, and compliance with external requirements. This meant that the actual information needs of managers were largely ignored. In addition, textbook and teaching material tended to repeat traditional cost accounting methods, such as standard costing and variance analysis, without encouraging innovation. As a result, students and future practitioners were not exposed to the new ideas that could improve managerial decision making. This academic neglect created a widening gap between theory and practice. While business environments were changing rapidly, management accounting, education, and research failed to keep pace. Johnson and Kaplan therefore concluded that academic had in fact contributed to the management accounting loss of relevance in guiding of organizational strategy and operation, and we agree with that.
This is the part related to needed innovations. To overcome these problems, innovation in management accounting is urgently needed. So Johnny and Kaplan, the writer of the article, suggested new approaches such as designation of management accounting systems that supports the operations and strategy of the organization. Next, they also suggest to increase the knowledge of accountants in regards to management accounting through experimentation and communication. Last suggestion here would be related to the development of new designs of systems for management accounting by creative managers and academic researchers to recapture the innovative spirit from the last 100 years ago during the scientific advancement era. So This innovation could help management accountant regain its role as a strategic partner in decision making.
In conclusion, the rise and fall of management accounting teach us a vital lesson. If accounting does not adapt, it becomes irrelevant. The profession must continuously evolve to match the change in technology, competition, and business strategy. As future accountants, it is our responsibility to drive innovation and ensure that management accounting remains useful and forward-looking.